Hey everyone, welcome back to Corporate Decoder. This week we're diving deep into Tilray Brands Incorporated's latest financial report, and let's just say things are getting interesting, especially when looking at how they're juggling their diverse business ventures. Before we jump in, if you love breaking down complex corporate filings into easy to understand insights, make sure you are subscribed. And hey, we've got a fantastic community over on Discord, linked in the description below where we dissect these things even further. Alright. Let's talk about Tilray Brands Incorporated's latest quarterly report. This filing gives us a really close look at how the company is doing in the 3 months leading up to August 2025. Looking at their financial position, Tilray Brands has total assets of about $2.1 billion. This is a slight increase from May 2025. A big chunk of this is in things like factories and equipment, which makes sense given their manufacturing operations. On the other side of the coin, their liabilities are around $562 million. This includes things like money owed to suppliers and other short-term debts. Now, for the fun part, the stockholders' equity. This is where we see a big number, about $1.5 billion. This is what is left for the owners after all the company's debts are paid. It is a healthy positive number, showing that technically the company has more assets than liabilities. Let's move on to how much money they are bringing in. For the 3 months ending the 31st of August 2025, Tilray Brands reported net revenue of about $210 million. This is a nice jump from around $200 million in the same period last year. So overall, sales are going up. But the cost to make and sell their products also went up to about $152 million. This means their gross profit, which is the money left after paying for the goods sold, actually went down a bit to around $57.5 million. This is a key point. Revenue is up, but their profit margin on what they sell is shrinking. Their operating expenses, which are the costs of running the business beyond making the products, came in at about $55 million. This is a significant drop from over $96 million last year. A big reason for this drop is lower amortization expenses. That is the cost of spreading out the value of intangible assets like brands or patents over time. They had a big hit from that last year, and it is much smaller now, which is good for their reported profits. This big drop in operating expenses led to an operating income of about $2 million. That is a huge turnaround from a loss of over $36 million last year. So, while their profit from selling products went down a little, their overall business operations are much more profitable now. After accounting for interest expenses and other non-operating items, they had a small loss before taxes of less than $1 million. Again, this is a massive improvement from a loss of over $33 million last year. And finally, their net income for the period was a small profit of about $1.5 million. This is a huge win compared to a net loss of over $34 million in the same period last year. It looks like the company is finally turning a corner toward profitability. The company highlights that they are using some non-GAAP measures, like adjusted gross profit and adjusted EBITDA, to give investors a clearer picture of their ongoing business performance. These measures strip out certain costs like the impact of acquiring businesses and stock-based compensation to show what they call core profitability. They say their adjusted EBITDA, which is a measure of operational profitability, increased to about $10.2 million, up from $9.3 million last year. This aligns with their story of improving operational efficiency. It is always good to look at these adjusted numbers, but remember they are not the same as the official GAAP numbers, and they can sometimes paint a rosier picture. Now let's break down their business segments. The beverage business saw a slight dip in revenue, down to about $55.7 million from around $56 million last year. They blame this on industry trends and their own efforts to streamline their product offerings, which sometimes means cutting out less profitable items. However, they did add in revenue from their latest craft beverage acquisition, Craft Acquisition 2, which is a positive boost. The cannabis segment, which is a huge part of their business, brought in about $64.5 million in net revenue. This is an increase from $61.2 million last year. This growth is mainly coming from their Canadian adult use cannabis sales, which jumped 12%. International cannabis sales also ticked up. Their distribution business, which involves reselling pharmaceutical products, showed solid growth, reaching $74 million, up from $68 million last year. They attribute this to a change in the mix of products they sell and also favorable currency exchange rates. And finally, the wellness segment, which includes health foods and beverages, brought in about $15.2 million, a small increase from $14.7 million. They are focusing on innovative, healthier products, and it seems to be paying off slowly. Looking closer at the profitability of these segments, the beverage segment S gross margin decreased to 38% from 41%. They attribute this partly to the lower margins of their new acquisition and the ongoing cost-saving initiatives not yet showing their full impact. The cannabis segment S gross margin also saw a drop, falling to 36% from 40%. This is happening as they strategically focus on higher volume, lower margin products to gain market share, especially in the price-sensitive Canadian adult use market. Across the board, operating expenses decreased significantly by 42%. As we mentioned, a big chunk of this is due to lower amortization expenses. But other costs like general and administrative expenses also went down, with lower stock-based compensation and rent contributing to the savings. In the non-operating income area, things are a bit mixed. They saw a loss from the change in value of their warrants, which is a financial instrument they issued. On the flip side, they recorded a gain from foreign currency exchange rates, which is always a bit of a roller coaster. A notable item here is a $15 million gain related to contingent consideration for the Montauk Brewing acquisition, meaning a potential future payment was reduced because certain targets were not met, which boosted their income for the quarter. Looking at the risks, the company still faces challenges. They acknowledge that their craft beer acquisitions might not bring in the expected revenue. Integrating these businesses is also a risk. Their cannabis business heavily relies on government approvals and staying compliant, which is always tricky in this industry. They also warn about the evolving regulations, especially in the US, regarding cannabis rescheduling and hemp-derived products. Competition is fierce, including from the illegal market, and their production facilities are crucial, meaning any disruptions there could hurt them. A specific risk they mention is their inability to raise enough cash to pay back their convertible debt, which is a pretty serious concern. In some late-breaking news, they recently acquired a promissory note from Afria Diamond Inc., which is a joint venture they have. They paid for this by issuing over 8.6 million shares of their common stock. This move seems to be about consolidating and strengthening their position in certain ventures. So, what is my take on all this? Tilray Brands Incorporated is showing some very positive signs, especially in their overall profitability and revenue growth in key areas like Canadian adult, use cannabis, and distribution. The significant reduction in operating expenses is particularly encouraging, indicating good cost management. However, there are clear pressures on their gross margins, especially in the cannabis segment, as they navigate intense competition and evolving market dynamics. The beverage segment needs a boost, and while the acquisitions are adding revenue, they are also bringing down the profit margins for now. The company's ability to manage its debt and navigate complex regulatory landscapes remains a critical factor. They are definitely moving in the right direction towards profitability, but there is still a long road ahead to ensure sustainable growth across all their diverse business units. Alright, that is our breakdown of Tilray Brands Incorporated's latest financial filing. What is your take on these numbers and what they signal for the company? As future, do you think they are on the right track? Drop your thoughts in the comments below. If this analysis was helpful, please hit that like button, it really helps us out. And of course, subscribe for more deep dives into the world of corporate finance. Don't forget to join our Discord community, linked in the description for more discussions and insights. Thanks for watching, and we, LL, see you next time on Corporate Decoder.